In the seminal case, Eisner versus Macomber, the U.S. Supreme Court held that income, for purposes of the 16th Amendment, and therefore for purposes of tax law in general, includes not only the income one derives from one's personal services, but also gain derived from capital. What this means is that when a taxpayer makes some kind of investment, which could mean, for example, purchasing shares of stock in a corporation, a parcel of real estate, or really any kind of property, the profit that the taxpayer later realizes on that investment can be subject to federal income tax. Section 61A3 of the Internal Revenue Code codifies this ruling by providing that the taxpayer's gross income shall include gains derived from dealings in property. The code measures this income, the gain derived from dealings in property, by a relatively simple formula found in Section 1001A. Gain is the excess amount realized over the adjusted basis. Section 1001C then mandates that whenever gain is so realized by the application of this formula, that gain must be recognized by the taxpayer, that is, included in his or her gross income. The statute defines amount realized in a sale or other disposition of property as the sum of A, the amount of any money received, plus the fair market value of any property received. Generally, this is simply the sales price, and the cash sale is a straightforward matter. If the taxpayer sells, say, a share in a stock of corporation for $100, the amount realized on the sale is $100. From that amount is then deducted the taxpayer's adjusted basis in that share of stock to compute the resulting gain or loss. If the taxpayer's adjusted basis in the stock is $10, for example, then the taxpayer has realized and must recognize a $90 gain. A taxpayer could, however, dispose of property for considerations other than cash. A taxpayer might exchange one property for a very different property without any cash changing hands at all. Say a taxpayer owns a bridge that he's willing to trade for a license the taxpayer needs to operate a railway. If he can manage this, the taxpayer will have disposed of his property since he won't own the bridge anymore, and thus a gain or loss rule of Section 1001 is triggered by this disposition of property. The taxpayer must now count as his amount realized the fair market value of the property received in the exchange. In this case, if the fair market value of the license, which is the property received, is greater than the taxpayer's adjusted basis in the property disposed of, or the bridge, then the taxpayer has realized and must recognize a gain. What if the property disposed of is encumbered by a debt, say, for example, a mortgage, at the time of the sale? If it's a cash sale, then the seller will include that cash in her amount realized, and then presumably use some of that cash to pay off the debt. Most loans require, however, that if the collateral securing the loan is disposed of, such as in the case of a mortgage, then the debt becomes immediately due and payable. In such a case, a sensible buyer will insist that he himself pay off the seller's debt at the time of the sale. If he doesn't do so, then the lender may come after him, or in particular, the property he purchased, to satisfy the debt. If the buyer pays off the debt as part of his consideration for the property, however, the seller has not received that much of the purchase price as money or property to include in the amount realized. The money was paid directly to the lender instead. The Treasury regulations anticipate this very common transaction, however, and require that the amount realized on a disposition will include any debt discharged as a result. Let's look at an example. A homeowner sells her home for $1 million when that home is encumbered by an $800,000 mortgage. In such a case, the buyer will deposit the entire purchase price into escrow, whereupon the escrow company will pay $800,000 to the homeowner's lender, the bank, to retire the mortgage and disperse the remaining $200,000 to the homeowner. Although the homeowner actually received only $200,000, the amount realized on the sale is nevertheless $1 million, $200,000 cash received plus $800,000 in discharged indebtedness. Let's now turn to the concept of adjusted basis. It is a long accepted interpretation of Congress's taxing power, that income usually means profit. It is thought, in other words, that the appropriate amount of income to tax, especially in the context of dealings with property, is the amount returned on the investment. That investment is called basis. Section 1012 of the Internal Revenue Code provides that the basis of some item of property is typically its cost. If a taxpayer buys a car for $50,000, then his basis in the car is $50,000. If the taxpayer later sells the car for $60,000 in cash, then he has a $10,000 gain. $60,000 amount realized, less $50,000 in adjusted basis, assuming that there were no adjustments to the original cost basis. That this math holds up even when the original purchase of the car was financed by debt. If in the above example, the taxpayer had borrowed all $50,000 to purchase the car in the first place, his cost basis is nevertheless still $50,000. And if he sells it for $60,000, his gain is still $10,000. This result is quite sensible. The taxpayer actually expended none of his personal funds in this transaction. He borrowed all $50,000 to purchase the car. When he sold the car, he presumably used $50,000 of the $60,000 that he received to repay the lender, leaving him with $10,000 extra cash. $10,000 extra in cash means $10,000 extra in taxable income. Sensible. Property may be acquired in a number of ways other than direct purchase, however. If property is acquired by gift, then the donor's adjusted basis carries over to the donee. Thus, if a taxpayer's grandfather gives her a pocket watch that the grandfather purchased for $10 50 years earlier, then the taxpayer's basis in the watch is $10, even if it's worth far more than that at the time of the gift. However, property a taxpayer receives as an inheritance takes a basis that is stepped up or stepped down to the fair market value at the time of death. Thus, in the above example, if the taxpayer had inherited the watch after her grandfather's death when the watch was worth $500, then her basis in the watch would be $500. The bases described above are best thought of as the initial basis of an item of property. Any initial basis may be adjusted by a variety of events subsequent to the property's initial acquisition. The owner may add to or improve the property, for example, in which case the basis is adjusted upwards or increased by the cost of those improvements. If the property is used in a trade or business activity, then the basis may be adjusted downwards or decreased by depreciation deductions that the owner takes against it. After taking into account these upward and downward adjustments, the taxpayer arrives at the adjusted basis that is used in determining gain or loss on the property's disposition. To sum up, the fundamental way to determine a capital gain is simply to take the price that the property is sold at and subtract the adjusted cost basis. The cost basis is generally the amount paid for the property originally, but can be adjusted later on by events that are subsequent to the purchasing of the property originally, but occur before the property is sold.